say make money, money, make money, money, money.
Hey everybody, we're back for another episode of Just the Tips. We have George, we have Gordon, and we have myself, Bruce. Thanks everybody for tuning in to this episode. Just wanted to kick off by giving you guys a little overview of the formats. Each week we'll present a bear case, a bull case, and then a moderator who will decide at the end of the session on who was right and who was wrong and which direction to go. This week, I will be the moderator. George will be presenting the bear case, and Gordon will be presenting the bull case on a new name in the market, a new name that just went public, a company that hasn't published any research yet, a company called Rubrik, which is a company that focuses on data and backup and storage, and our favorite subject, security. So we'll all jump into that in a second, but first we wanted to just say hi and welcome, and good to see everyone and catch up for a little bit. How's everybody's Mother's Day?
I hope you brought your boxing gloves, because I'm going to knock you flat on your ass.
You're out of your weight class, kid. Things are great, man. Can't complain. I have lots of babies and mothers, and I have my mom's still kicking around. So yeah, it was a wonderful day of gratitude to the mothers in our life.
So Bruce,
Nice.
what did
Nice.
I love hearing your one percenter story. So tell me, what did you do for your queen on Mother's Day here?
The bottom 1% story, just to be clear for everybody who's listening here. We had a really nice brunch, and then the kids really wanted to go to the library, so she ended up with all the kids, taking them to the library on Mother's Day. And I got a lot of shit from everybody I told about what we did on Mother's Day, because apparently you're supposed to take all the kids and let the mother pamper herself kind of thing, which didn't end up happening. So I'm like in the doghouse or penalty box following Mother's Day, but luckily we have next year to make it up to her.
What?
Well, I would always think
I don't understand that. It's Mother's Day, right? Aren't you supposed to spend time with your kids? That's what my wife tells me on Father's Day, because the same thing happens in this house. Mother's Day, and she's here. All the kids are you, and then comes Father's Day. She's like, don't you want to spend time with your kids? It's Father's Day.
Yeah, I always say, here's my sound advice. Everybody, just tell your wife every day is Mother's Day. So why would we do anything different? I don't know why. I've been divorced before. I don't get it. It's weird.
Yeah,
our audience is going to start skewing very male here, I think. I was just noticing this colorful thing behind you there. Is that like a hammock?
Oh my God, it is. You nailed my hammock in my office. It is not a banana hammock. It is just a...
Yeah, it's a little too big for you.
It's my charging station. That's probably a first for most people. The indoor hammock in the Zoom call. Anyway.
After I slap you around here on Rubrik, you can go recharge in that. That'll be fine.
Yeah, that's right. I'm podcasting from my hammock. All right. So anyway, with no further ado.
News segment.
We're going to do a news segment. Is it fall to me to do the break?
That's right, Gordon.
The 1960s
let me hear the news jingle.
All right, here we go. News. How's that?
I think it's going downhill each week.
I was trying to add like this sort of like battle cry in there.
I thought it was like the kind of, you're adding the like Mexican flair to it there with the...
It was the Columbia protester cry.
I think without reservation, we can all admit that was one of the worst interpretations of the news jingle we've heard.
Yeah, I preferred the techno version we had last time. You have it in you. I know you
already
do.
News.
Jumping into the news then for a second, a couple things we wanted to hit on. There's been some big earnings reports, one that just happened, one that's on the docket for this next week. But before we get there, our friend Roaring Kitty, a.k.a. Keith Gill, is back from Wall Street Bets. And he's not back in classic form, but he posted sort of one tweet that referenced his old GameStop video, and the stock, I think, tripled or quadrupled over a kind of 2-week time period, and then came back down to earth a little bit. GameStop didn't waste any time in filing to sell a bunch of more shares into the market at these elevated prices, which pushed the stock even further down. What do you guys think? This is the first kind of reoccurrence of the meme stock craze since interest rates spiked to 5% and we came out of the pandemic. You think these things will continue to rear their ugly heads? I think, Gordon, you had a really good analogy for meme stocks.
Yeah, well, actually, I got to give my old boss credit. It's like a faucet of money just flowing out, and you just put your cup under there, and all you have to do is catch the money. But every once in a while, a knife comes out and cuts off your dick, and that's what happened the day after. So, yeah, if you can time it right, it's not investing; it's speculating. It's the greater fool theory. Some other idiot's going to drive the stock higher. But don't worry, I'm not going to sell. Hold. It's absurd. It's pretty funny that people made the point that, investors aren't buy these risky venture capital investments, yet, in the markets, they're allowed to just, bet their life savings on margin for these crazy stocks. And it just seems absurd. I mean, there's a problem here, but if you believe that, this is a victimless crime, like anybody doing this kind of knows that they could lose their money and to be the nanny state and be like, well, you can't do that. That seems wrong too. But I just, as an investor, I just can't participate in this, even though it's incredibly tempting. But it doesn't feel like this is a good thing, right? It doesn't feel like it's a good thing that this sort of the Temu version of Luke Wilson or Wish version of Luke Wilson posts a meme of a gamer leaning forward in his chair and his stock goes from 10 to 50, then back to 20. Like that just, you just want to look away. I want to avert my eyes. It's fun to watch, but it doesn't seem like something really great is happening here.
Oh, I like getting on the short side. Give me opportunities like that all day long.
You didn't short GameStop or DJT, right? You didn't short.
No, I was looking at the option chain. I was getting ready to, and then it fell, and then it fell again. So it didn't stay stratospheric long enough this time for me to do it. But no, that's the kind of bet I'll take all time. So I like to play those kind of things where I can.
Well, look at Trump media, right? Like it's back up to $51. It was at 32. This is insane, right? Like it's a $7 billion market cap for a company that's like just burning cash. There seems to be like a bid out there from, maybe we'll call it the idiot bid on a lot of things. And I don't know how to take advantage of it. Like valuation wise, I'm shorting GameStop and Trump media all day long, but like fundamentals, focusing on fundamentals, like that's not the only thing that drives stocks, right? But I frankly,
the market can stay irrational longer than you can stay liquid, is the old saying, right? Yeah. So I never go huge size on any of these. It's always what can I stand to lose? If this goes 2x the wrong way in my face, am I still smiling at that point? That's usually my analysis.
I think I'm going to start just trading Tommy Tuberville, right? Like you see that Tommy Tuberville's got like these long dated puts on Lattice. He's got long dated puts on a number of stocks. That's fine. I'm like, Jesus, this guy invests like me, and that was not a positive realization. Tommy Tuberville, he's not. Politics aside, this guy's kind of like a potato intellectually, but smart enough to buy long dated puts on Lattice. I don't know. I assume that's like a play on Trump getting elected and just like him destroying anybody's China business. I don't know what he's doing, but sure is interesting.
I think it's just I think you have to look at it really cautiously. Look what happened to Melvin Capital originally when this GameStop call was made on Wall Street Bets. The funny thing is, like, GameStop for a lot of people has been just a totally middle of the fairway consensus short for so long. It wasn't like they were trying to defy gravity here with some like
a troubled business model.
Call. It was just the middle of the fairway consensus short, and then all of a sudden took on a life of its own in a Reddit community and just ended up crushing the hedge fund. And I think they ultimately went out of business. So I think you do have to size appropriately here. Otherwise, you can end up like very significantly out of position.
Size matters, like my wife says sometimes.
And yet she's still with you.
Speaking of size and performance, just one thing that we forgot to mention at the top here, anything that we talk about here should not be used as a guidance towards investing. Future performance, undue reliance should not be placed on anything we say. Forward-looking statements involve known and unknown risks and uncertainties, which may cause actual performance and financial results in future periods. So do not rely on anything we say. Do your own research and make your own decisions.
Oh, I feel so safe now. It's a safe harbor. I can say it.
I thought you missed the part about buffoonery that Gordon likes to throw in. That really pumps up the podcast. And we're talking about buffoonery, so make sure to throw that in next time.
That was intentional.
All right.
Hey, one other thing on the news front that I thought was interesting that I was watching here during the earnings cycle, maybe I'll just throw it out before we jump into the main event, was watching the earnings of a lot of the cloud platforms. And so I would say the quarters coming up to this, if you looked at Google, Microsoft, AWS, like all their cloud offerings were slowing. And so coming into this quarter, each one of those started to re-accelerate. And to me, that was a really interesting signal out there in the marketplace. And so it seems like investment is picking back up where it had been slowing before. And I think it's quite a bullish signal for not just those stocks, but across the board. We saw DigitalOcean reported they had a good quarter. They're also a cloud stock that we weren't as bullish on, but I think they're also benefiting from that. And the one that we had talked about once before on the news that actually I've been nibbling on a little bit, lesser known for their cloud, but I think they're well positioned for AI workloads in the cloud is Oracle. So that's another one. And they got a little pop actually this week from Elon's X.AI announcing they're going to spend lots in the Oracle cloud. And obviously Elon and Larry Ellison are like best buds. So there's a little bit of a incestuous connection there. But anyways, Bruce, I see I want to say something about probably your long DigitalOcean.
I bought it at 35, and so I'm up a little bit actually on it. It went down to like low 30s and went to high 30s. It's bouncing around. But you look broadly, the software world, most companies guided down for software. But the exception was the cloud guys, right? So Amazon, Microsoft, Google all grew their cloud better year over year. Like things are less worse. It feels like on the cloud side. But what's unclear is how much of that upside performance is driven by AI, because it seems a lot of like, OpenAI from Microsoft, Amazon. I'm getting ads from Amazon on my phone about their AI capabilities. And obviously the big three have more AI capabilities than these smaller players who are just playing catch up. We talked about DigitalOcean. I don't know. I feel like it's still a pretty shitty environment, broadly speaking. NRRs are not really falling much anymore, but there's not a lot of upside and people are afraid. And anyway, I think it's a weird world of, generally speaking, things are not very good. But if you have AI and you're selling public cloud, things are a little less worse.
Yeah, I agree. I actually think like we're not out of the woods yet in enterprise software. And if anything, it feels this past quarter has like modulated expectations. I think especially given the fact that it looks like an interest rate cut is going to get pushed out here in the kind of the best case scenario. I'm still advocating for an interest rate hike, as my hot take going back up.
The principle is not going back in, dude. Like there's an election. I don't know if you know about that. There's an election in November. I know you're pretty busy with your helicopters and stuff, but I feel like
I think in order to kill inflation once and for all, we can hope that it goes down by itself, but I think there's only one real tool.
It wasn't bad last time. It was not as bad as the law, right? It was 3.3.5%.
It basically came in within like I think a 10 basis points of where the expectation was, but lower. I still think it feels elevated, and we have basically full employment, and we have markets at an all-time high. I think everything came in a little bit lower than the expectation, but not enough. If we're targeting 2%, we're still way above that norm. If inflation actually does come down significantly, so it goes from being 3+% to being 2+%, I think that has a meaningful impact on like Biden's chances potentially, or could impact Trump as well. Although Trump tried to influence the Fed pretty directly when he was president, so it'll be interesting to see what happens there when that issue comes up. But going back to enterprise software, I will say, I think you're right. I think like AI has been an enormous tailwind for the hyperscale cloud companies in a way that hasn't been true necessarily of the broader enterprise universe. I also think like it's interesting to see how much capital they're putting to work here, both in terms of CapEx and OpEx against AI. I don't think I can remember a time where you had a new technology be prosecuted as definitively as the hyperscale cloud companies are doing with AI. Like they dabbled in crypto, for example, they've dabbled in IoT, they've dabbled in some of these kind of frontier technologies in the past, but it feels like they're putting $10+ billion to work in each of the hyperscale web companies against the notion of how AI could potentially help their business or be disruptive to their business. So it feels like a really kind of step change function in terms of how they're looking at this market, and it has borne itself out in terms of the early returns on their results, at least for the cloud parts of their business.
We got to talk about GPT-40 for a second, right? The
girlfriend.
immediately what I thought about was like, holy shit, my future sex robot has gotten way more convincing. And just this, it's really scary. I would say scary. I would say exciting, right? When I heard that tutor, I was like, this is real. Like, this tutor sounded like a real person walking somebody through how to, like, it was the Pythagorean theorem, right? Or it was like better than most human tutors, and it was like that she voice. Like everybody was, or sorry, was it her? It was like the actress.
Johansson.
Scarlett
Johansson.
Johansson. Yeah,
I've heard of her.
I don't know why they picked this super sexy voice to do it, but suddenly I'm like, I was a bit of a skeptic. When I heard that, and then like even on All In, they're talking about like how they just fed All In transcripts, and they were able to, AI was able to rapidly review it and provide David Sachs's view on Ukraine, which I don't have a lot of interest in, but it was impressive. It was like clear elimination of 10 hours, 20 hours of work, and done well. Suddenly I'm like, holy mackerel. And then CoreWeave raised a bunch of money, a bunch of debt, and made a huge commitment to spend a bunch of money on public services. Like we're seeing this over and over where people are, startups are making these big, commitments with Microsoft, et cetera. They're going to spend a whole bunch of money with them because that's tied to customer engagements that they seem to already have visibility to. So it feels super real to me now. I just feel GPT-40 was a tipping point where I was like, holy mackerel. We went from this really almost like parlor trick, cool things that ChatGPT can do to this sort of like future world where you're talking to the Star Trek computer and it's conversing with you like another human. Like it was really good. GPT-5, by the way, Sam is talking about GPT-5 being like making GPT-4 look just like child's play. So suddenly I'm like, this is different. It really is different this time. So anyway, go ahead, Georgie.
Yeah, I think the other thing that separates it, right, is the ability to process the environment. And so the demo I saw was someone talking to it and showing, it was observing the room that the announcer was in and making comments about it, weaved into the conversation. The old thing was the Turing test, right? Could you tell you were talking to an AI? If I just tuned into that conversation, I would not know that was AI. Maybe the last thing on the topic, and we should move to our main event, but I do agree. I think that cloud spend is being driven by AI. And the question becomes, right now it's an investment period. Everyone's investing. Everyone feels like they have to have it or they're going to be left behind. But I think the monetization of it is still really lacking, right? I think Microsoft and others that are offering Copilot, like I've heard very mixed reviews on how many people are actually taking Copilot, and people are scared to deploy it in their environments. I look at early stage companies that are trying to build applications around it. And there's a couple that are scaling, but there's not a ton, right? What are the end user applications that are making money here? And so it'll be interesting to see where this goes from. You can invest for so long in enabling the capabilities, but then where are people going to start paying for this? Where is it driving the efficiency? So it'll come. I don't doubt it, but we're not there yet. So I think that's the gap that we're seeing the investment period, but right now it's not being monetized and it's not showing up in those software results.
You sound a lot like me in our first episode, just skepticism. But when I heard that GPT-40,
I'm a long-term believer.
Yeah, I just feel like though what we can't see is all these companies are just seeing gold. Like they're seeing opportunities to like fire people and replace them with AI. But when I heard GPT-40's voice, I was like, every customer service job that's out there is going to disappear. And I don't know how long it's going to take. But like the days of screaming representative are going to be over very soon. If you can't tell it's not a human, like that's over. And that's literally like 1 million people working in customer service jobs answering phones. So
yeah,
this is real.
I watched a demo the other week where we had a live customer service agent on a website. We were typing, and then we trained a chat GPT model to go train on the knowledge base of the company. And we put them side by side, and the experience was better with the virtual agent than the real agent. The real agent was slow. The responses were very canned. They were just looking up the answer on some sheet. GPT actually sounded more like a human than the real human. So the quality was already better. It was actually amazing to watch.
I'm willing to bet that your company, at least my last company, had a lot of costs associated with support. Yep. A ton. And so just eliminating that entire group or taking it down to 1 or 2 people who get elevated from AI, like that's a real opportunity. Right. So anyway, like I'm suddenly like an AI bull. For me, like NVIDIA's report next week is the most important financial event every quarter now, right? Because there's an entire ecosystem. Everyone's watching. It drove the market up last time. It saved us. They have demand. Like, there's no way they're going to miss, right? They have orders going out many quarters. And we know that. So the question is, is there anything they can say to make their stock go up? Can they really get more capacity whenever he's capacity constrained and really, exceed expectations? I don't know that they can. I think they are going to exceed. They always have some backup. But I just don't know if you can physically produce enough of these chips and to really blow numbers out the way they have the last 4 quarters. I just don't know if it can physically
supply constrained. It's going to come down to Jensen's choice of jacket. That's what's going to drive the stock.
Yeah, I found the last one. It's Tom Ford, $9,000. My birthday's April 6th, guys. You got a lot of time to save. A lot of time.
I think even that feels low end, right? $9,000 like a $2 trillion company.
Does he have a closet full of like old jackets, or does he donate them to the Goodwill in Palo Alto, or like where do they go?
So time for the main event. As we mentioned before, Gordon will be taking the bull case on Rubrik, and Georgie will be taking the bear case on Rubrik. I'll turn the mic over in about 15 seconds to Gordon to kick things off, but just as a little background, Rubrik is a company that just recently went public in the last couple of weeks. It's been viewed as a barometer for enterprise software broadly. I would say within the tech community, people are looking for any sort of green shoots that they can find in terms of companies that are willing or able to go public. We'll talk about it a little bit more. Rubrik really has some of the kind of premier operating metrics that you would look for in a company that was accessing the public markets. It's a very interesting company. It has a lot of maybe the hallmarks of things that we would look for great companies in the public markets, and really looking forward to an engaging debate. So with that, I will turn it over to Gordon to kick things off.
Can I just say before Gordon jumps in, it has been interesting in the IPO market. These standards have definitely risen, right? And we've talked a little bit about this before, but you used to be able to go public with 100 million, 200 million in revenue. And now outside of maybe Astera Labs, you're not seeing that. Much more mature businesses here like this. So anyways, why don't you go, Gordon? I was just admiring these good looking guys up here on the screen, but
yeah, man, I love my orange blazer. I'm like the team.
Is that money coming out of your pocket, or is that a handkerchief? Do you wipe your nose with $100 bills?
It is not a Tom Ford jacket, unfortunately. I'm not in that bracket yet. We'll get there. They don't have a lot of orange leather jackets. Anyway.
Enough money, you can find whatever you want.
So anyway, yeah, this is a really interesting one. I call the title of this Rubrik-on. An alternative title might be Rubik's Cube. I think mine's better. That was Bruce's idea. But yeah, man. So I actually have some familiarity with this. This is one of sitting squarely in the middle of the sort of like, is this a storage company, a security company debate? These are the poster child for a company that somebody could just bearishly say, this is just storage and that's a commodity. But these guys have done a great job making it a security story. There is a real security story here, I would argue. So some fast facts. I could use you guys just help a little bit on describing what these guys do. So we'll go back and forth, but some very high-level thoughts. If I was on the elevator and somebody said, what do these guys do? I would say they're backup with ransomware protection focused on cloud, right? So you have a big pile of data, you have a bunch of files, a bunch of porn, whatever you have, you buy a server from Rubrik, and it used to be you'd buy hardware and you put software on there, and that software would look at your data and go put it on the server so that if there was a problem, if there was a virus or something, you go back to that backup and restore very quickly. Like that's the value prop. And they went from like an appliance model where you'd buy a server from them, probably built by Supermicro. That's out there on Reddit.
They do use Supermicro. I noticed that.
Yeah, but they're trying to get out of that business, right? Like there's a lot of people that were selling boxes that now want to sell you that same box, but in a public cloud environment where you just don't have to manage the box. You just send us money every month, and we put your data in a place in the cloud, and you don't worry about it. And that's wonderful for both sides in a lot of ways. Like you don't have to deal with all the idiosyncrasies of on-premise environments. If you do a software update, it's done for everybody all at once. It's super profitable, as we'll see. So there's a big part of the story that's just transitioning from selling boxes on-prem to a Microsoft partner. They use Microsoft primarily for their cloud. They just went public
April 25th.
Yeah, and stock's up some since then. It's now trading, I think, at 36 and change, which is like almost a $7 billion valuation. In their S1, their main competitors are data management and protection vendors. Surprise, Dell EMC, IBM, Commvault, Veeam, Cohesity. That's the space that they're in.
A lot of legacy names there, interestingly, right? Dell, EMC, IBM, Commvault. Those are all folks that have been around a while. Veeam, I think this private company, they're a little more cutting edge.
Yeah, they got bought
Cohesity
by the
was a
Russians,
venture back.
I think. Yeah.
Yeah.
So
But
There's
has
probably
recently
even,
been combined with a more mature company, right, by PE.
yeah. And by the way, those
And
guys
there's-
don't. Yeah, they're Dell-like multiples, right? Storage never got a good multiple, like ever, right? Storage has
And why is
growth
that?
margins. Because there's a lot of hardware, and storage is ultimately, it was a commodity, and they were not doing security, right? Like security was something you had to buy separately. Like these guys were selling NAS devices, but you got to protect from ransomware, you got to call somebody else. It's very interesting debate about like, where does storage begin? Is storage worth paying a multiple for? And where does security begin? Because ultimately data has to be protected. That's what storage does, is making sure that it's there. And security is part of that. It's not just about deletion or hardware failure. It's also about bad guys and keeping them out more and more. So
one question for maybe both of you as you're thinking about this, or as our audience is thinking about this, like how much of the story here is based on the narrative on whether it's storage or whether it's cybersecurity, and how much should just be based on the pure sort of operating fundamentals?
metrics,
Like this
growth,
company
right? Yeah.
is growing, this company has software gross margins, this company is in this big of a market. Like where should I draw the line between operating
The answer
fundamentals
is,
and the
who
narrative?
cares? If it's growing X% and produces X margin, that's the business. Like the proof is in the pudding, right? These guys have a scoreboard already. And so for me, I had that thought coming in. I was very skeptical, but I'm actually pretty freaking bowled up by these metrics. And I think the stock's super cheap. But let's talk really quick about pedigree. You guys mentioned
I would just echo like what you're saying there. I think the gross margins are always a great story for, are you dealing with a commodity or do you have pricing power in the market? And so I think these guys are definitely heading, their gross margins are saying they have a differentiation, right? And the software provides that. So I would agree. I think they're more of a security play. And if you go on their website, like that's all you see. That's what they're pushing. That's what they're selling, right? So end of the day, like it doesn't matter. I think look at what the financials are telling you, and the gross margins here are saying, hey, this is more than just a commodity business.
Jesus Christ, are you a bear or a bull?
I know,
Hey,
I can't figure that
I'm
out either.
not going to argue. I'm not going to argue things that don't make sense. So
All
don't
right,
worry.
well,
I'm warming my gloves already, right?
This is why women choose the man, not the bear. So anyway, back to the really quickly. Let's talk about pedigree. A lot of people look at this, especially VCs. Have these guys done anything good before? Mr. Sinha was a founder of Nutanix, which I think is a reasonably good story now. Another story that was on the border, but they're more storage focused, right? This just adds to. By the way, I took this from an overview by a guy named Chris Wall over at Rubrik on YouTube. It's still there. And by the way, like the story when they were talking about there was more about storage and less about security. But these people, like they've got like a Google guy, they've got a co-founder of Oracle Exadata, a distinguished engineer from Riverbed. Riverbed was a decent story. Kind of like, there was a blow up there because it was a hardware story also. But these guys are winners, right?
Yeah. Arvind Jain, by the way, he actually left, and he has another startup in the Valley that's doing quite well. One of the few companies that has a end use case AI application called Glean that's doing quite well. So, yeah, it does seem like these guys are
winners. Yeah, they're winners. They're not losers.
I mean, he goes by the name Nitro. His name's Arvind. He goes by the name
Really?
Nitro.
I've never heard that before. Nitro?
Isn't it also like a gladiator name from that gladiator show from the 90s? Nitro. There you go. I didn't notice that. Thank you for noticing that. I go by Magnum, but nobody calls me that. I keep trying to get them to tell me Magnum.
I think they call you Pee-wee instead. But
yeah, they
sorry.
call me little Pee-wee. I don't like it. Anyway, people are mean.
What's funny about that is like Arvind is not even a hard name to pronounce. There's no reason to change it.
Nitro?
Like,
We got to get this.
I'm going to go by Nitro.
AJ sounds a lot cooler, though. That's the nickname there for Arvind, right? Arvind Jain. He's now AJ. So you got to have a cool nickname if you're part of this team.
There's got to be some cocaine in that story. Maybe. I don't know. So Nitro. Long night of coding ahead. Anyway, look at these investors, right? John Thompson, former CEO of Symantec, former founding CEO of Veritas. Dear Lord, could you get a better lineup?
Good investors. I believe Sequoia lost all their money on FTX, but anyways, just having a good name behind you doesn't mean you're a winner.
Money on Nvidia though, right? I think they've been okay. I think Nvidia is paying the bills for them. Yeah, they're doing all right. So anyway, the great pedigree. I like to call this the money shot. Like a lot of software S1s have this, which is like key metrics. So these had 784 million in ARR. So it's a forward-looking metric. They actually haven't done $784 million in revenue. That's really what the run rate of their business is, because the retention is very high. Their cloud business, we talked about transition, going from hardware to software. Within that subscription ARR, there's still some on-prem, but it's real, right? People tend to renew. They have this thing, we talked about NDR, like they just do nothing. Their customers on average are growing over 30% per year. So 30% growth is in the bag. That's cool. Let's keep that in the back of your head. Almost 2,000 customers paying over 100K a year. That doesn't sound like a commodity product to me. Like they're doing something useful. 99 customers paying more than $1 million. There's a way more customers out there that pay a lot more. This isn't the, like.
And maybe Gordon, before you jump in further, like maybe it's helpful for the audience to describe like their transition in business model, because we're talking about focused on their ARR, which is, hey, we've got a subscription business, but they haven't always been that. So maybe that's helpful.
I'm gonna put a pin in that.
All right.
I think it's important we talk about it because this is cloudy, right? Grown, where it's just looking at their revenue metrics historically probably isn't the best way to look at it. You got to look at what's happening within the pieces.
Because they have 4% growth. Is that why?
Yeah. But then they have 47% ARR growth. We're going to get into that, right? That ugly bad business is going away. This is the classic, but they've managed to wait until that transition's almost over. Like they're almost through it. So anyway, like this is worthless, I think, this picture from their S1. Like here's what we do. Like every company has this thing. It's just like useless. So, and I know you took a shot at this too, Georgie boy, but at a really high level, I already explained this. Like these guys take data, there's a software layer, the software takes the data, puts it somewhere safe, and makes sure that nobody can enter it or delete it. And that's really what they do. And one of the big things is ransomware, right? So what's ransomware? Ransomware, this happens there, it's coming to the consumer too, right? Basically people say, if you don't do X and pay us, we're going to delete all your data. But there's a bunch of bad actors out there, right? And we've seen a lot of public institutions too become completely paralyzed, unable to do anything because some ransomware pirate has said, hey, I've got your data. You can't access it. You're locked out, and I'm going to delete all of it if you don't put $1 million in this of Bitcoin in this account. And it's a real problem, right? This is actually happening all over. Like the average ransom payment is $800,000. The average total cost is estimated at $4.5 million. It takes 49 days to identify ransomware. This is horrible. This is a house on fire. And this is a lot of houses on fire, and we're always putting them out. And so there's a lot of value created here just to allow the IT manager to sleep at night, so he has to wake up to a nightmare. And so that's real. And we talked about
and that one I think we mentioned when we talked about in the news, the United Healthcare attack, right? That was, they took almost $900 million charge in Q1, and they're estimating now that it's going to be up to $1.6 billion total charge for ransomware. That's a meaningful amount for a public company. I mean, that blows my mind how much, that event hit them. So if you're an IT manager sitting inside of an organization and you're like, holy crap, I'm going to get fired over that. I should spend some money on ransomware protection.
Again, we can't figure out if George is the bear or the bull, but we will.
I'm building it up before I tear it down.
The one thing that I'll say
in high school, right?
The one thing that I'll say,
that girl kind of thing, right?
The one thing that I just want to say in terms of what Rubrik does is, and I think they've been really successful at doing this more so than maybe most enterprise software companies, is they transitioned their business model really from being a data and backup recovery, a storage company, to being a security company. And it was amazing to see that happen, because one of those categories, obviously, as we alluded to, is treated as a commodity type business. And one of those businesses is treated as a very high value part of the business. Obviously, different multiples apply to each of those different segments of the market. But I think the thing to understand maybe for our listeners is what Rubrik does is it secures your workload. So if you're an enterprise and if you have different types of workloads, whether it's coming from S3 on Amazon or Office 365, oftentimes large enterprises are using a ton of different enterprise type services. And in order to back up all of those different services with kind of a single pane of glass on a single platform, you need a platform like Rubrik that has identified all those different workloads, can back up all those workloads, can classify those workloads. So this is important material. This is important material for only some people. This is stuff that can't be shared with anybody else, like social security numbers, for example. And this is how I classify that information. So only George can see that information, or both George and Gordon can see that information. And then lastly, it's how do I take all that data and how do I govern that data? So folks that are coming into the enterprise, folks that are trying to steal that data, oftentimes with ransomware itself, they're actually not exfiltrating the data. They're not taking the data out. They're just coming into your environment and locking up the data and saying, hey, in order to access this data, you have to pay me X amount of Bitcoins or some sort of bounty. And so what Rubrik does effectively is it says, hey, we took a snapshot of all that data before it got hacked. So we can refurbish your data environment with the old data that's pretty close to the data that you had before the hack, or pretty close to the data that you had after the hack. And we can make it so that you don't have to pay this ransom and you can understand what was compromised. So it's really a platform that allows you to do a lot of things with data that you weren't able to do, I think, historically before. And then it also gives you some of the tools that enable you to protect yourself from a security standpoint. And it brings that all into a singular platform. So it's really a one size fits all for all of the different workloads within an enterprise environment.
It's really interesting. Like, I just keep thinking about Nutanix here, right? Like, it's the same thing, right? Except it's Nutanix plus security. And if you look at Nutanix, they're trading, growing 10%-ish and trading like 7 times. And they're getting that multiple ballpark right now, around 8 times. Now they're losing a lot more money, even though they're growing faster. So we'll talk about that piece of it. But today, it looks like the market is treating these guys like more Nutanix, even though they're growing way faster. And I think they really are getting accepted as a security company in the tech world. I'm just not sure the multiples there. It could be because they're losing money. Let's talk about that for a second. And so please bear with me, because I am going to get to the transition. I know you like talking about post-op transition, but they only technically grew 5% in fiscal 24 during January.
Hang on to your seats.
So you think, oh God, 5%, this is a startup? Really? But again, we got to talk about the transition. And the other thing that's really ugly here is their sort of non-GAAP op margin was getting worse, right? They lost a shit ton of money. There's not a lot of numbers below the line. They don't pay taxes. They don't have some interest payments to stock comp, but not a lot. Like, these numbers are not that unclean, but they basically had a negative 40% op margin last year. Like,
almost 50.
Let's show you the good part. You got to dig underneath. You got to dig deeper to get the insights from the S1. As they pointed out, like, they went from like a perpetual license where you pay one time and have to replace it 5 years later to a recurring model where it's in the cloud or it's even on premise. You just pay a subscription every month. And that piece of it is growing 40%. It's a rocket ship. That's why they went public. That's why people bought the shares. So you just take the part of their business that's recurring, like a subscription piece. They're doing about $784 million a year, and that's up 47% year over year. By the way,
it used to be growing a lot faster than 40%, but we'll get to that.
We'll see. We'll keep getting there. So then here's the Magic Quadrant. I know you love the Magic Quadrant, Keith.
I'm sold. I'm sold. If they're in the upper right hand of the Magic Quadrant, ask no more questions.
But look, it's moving up and to the right. And by the way,
they must be paying Gartner they must be paying Gartner more each year. And maybe that's where the negative 47% op margin is going.
Yeah. But the thing is, though, this kind of is validation, right? Like, even Gartner's backward looking, right? They're like basically a backward. That's a criticism of these guys. So you kind of argue these guys they're almost all the way to the upper right. Like, they're definitely in the store. They're actually their competitors. If you look at those, they're really storage software. And nobody's really in that group is really trading it a million times, but at least validates these guys are doing something differentiated in my mind. Like, they're clearly doing something different and taking share. There's a big article in July of 21 where Register was just pointing out that IBM had fallen out into the challengers bucket. They must have wrote a big check because they got into the visionaries bucket later, but something's happening. Something changed in the storage world. In the second half of 23, I found this kind of interesting. Rubrik grew 13% in the second half overall. But again, there's a lot of transition in there, which is above everybody but Veeam. Wasn't super excited to see Veeam outgrowing them. And their share isn't big enough to make this list. They're still in the others bucket, but subscriptions going 50% underlying in that same time period. I don't know. It's mixed, but they're a real player. This is a growing market, just to validate somebody, again, some grain of salt, because these guys always can't sell a research report that has 2% growth. You sell a lot more when you're forecasting big growth. And so there's a lot of kind of groupthink in these things, but they're saying this market's going to go 22%. That's your baseline. What's really different? They're saying, hey, look, like, immutability means you can't delete. And I guess Rubrik has a really good story around our stuff really is immutable. And it's because we start not through, this is really inside baseball and technical stuff. not through a hardened Linux repository or through object storage. Do we do the data security? I don't know. At the end of the day, for me, like the proof is in the pudding, like all this shit they put out there about basically they're saying we're a security company, everybody else is a storage company kind of thing. And the proof's in the pudding. I call this my glory hole checks. Like you get a fair amount of stuff on Reddit, the glory hole of the internet. There's some validation out there. People saying that one thing that bothers me is that you don't care about price and it's great, but this person's saying, look, this thing pays for itself. It's a no headaches kind of thing. IT people love it when they can just set it and forget it. Like that's what they want to do. Nobody wants to worry about this shit. It just needs to work. And somebody else said here for on-prem VM backups, I think Bruce alluded to this, which is virtual machine backups. Rubrik has been second to none. So there are fans out there for sure. Stocks up from $32, to 36 and change. I was able to find some stuff from altimeter on this stuff. Now this chart, like the stock's actually above where the range they had. They're saying that basically at $34, this thing would be, if you assume 35% growth overall for the company, it would be like 7.5 times next 12 months revenue at $34. I actually redid this, so it's more like, kind of 8 times 35% growth where it is now. So 8 times EV to sales.
And it's fair to say that one of the challenges here, right, of a new IPO is you don't have forecasts sitting out there. And so that's why we're putting out some of these ranges or these guesstimates based on what it could be, including management hasn't really guided the market, right, which will happen after their next earnings call. So right now it's a big kind of black hole and you say, okay, what have they been doing historically? And then do they go up or down from there? Right. I think last quarter, at least their ARR growth was 47. And so what's the appropriate multiple that you would put on that as a way to think about it? Would you agree with that?
This is just math, right? This is the valuation that it would have if it goes 35%, right? So we're saying, okay, let's take last year, multiply times 35% or the last 12 months, which I guess is last year technically. And what would the valuation be? So there's no speculation here. This is just straight math. But the real question is that lead weight of maintenance and other revenue that's falling like a rock, is that falling enough so that underlying ARR growth will get them overall growth 35%? Like that's a real question that I think we can answer, but which we will come back to. But I did a list of, nobody's growing 47%, but I did a list of a whole bunch of cloud players here. I threw some storage names in here to be balanced, like Nutanix and Pure, but that group is trading on 2025 sales about 12 times EV to sales, which is a little bit different the next 12 months, but not hugely different. It would actually be a little higher for next 12 months EV to sales. I'm not even going to talk about price earnings, but I like, because nobody makes money, but EV to sales growth on 25s, we love that metric, right? Because it controls for the fact that people have different growth rates, and therefore if you're growing faster, you should have a higher EV to sales growth. And so we look at a ratio, and this group is trading like 0.6, 0.7 times EV to sales.
I will say on your list, the only true competitor they list there is Commvault, right? And they're probably the best of the bunch.
They're growing 12% next 12 months, and they're trading at 6 times. But they're growing very slowly.
Just as a note, it's amazing that in 2024, both on the average and the median of these kind of Rubrik comp tables, they're trading at 1, which is where you'd expect them to trade. It's almost like the market's efficient, crazily enough.
I look at that out year. I always look at out year. I like that metric a little better because it's forward looking, right? The more forward looking you are, the better you are because markets are forward looking, right? And so I think that 2025 0.7 is kind of right. By the way, a 35% growth, it'll be trading at 0.2 times EV to sales, or maybe a little higher. It's way lower than that.
Yeah. And one thing I'll say on you, like when you look at the closer, and I'll get to this in my section, but if you look at a Commvault, like they're going through the same kind of transition, right? So they are also have legacy revenue. They do have a ARR figure that's growing faster underneath their business. And it's not really fair to give Rubrik the advantage of, hey, what's the ARR growth that they're driving and not do the same for Commvault. So the growth rates you see here are actually understated. I think they're closer to 20% growth on their transition business.
On their SaaS business, they got a transition right there because they have so much legacy. And
Commvault, I think, I would say, sitting on the sidelines here, I think Commvault isn't the greatest of comps. Just I know they're going through a transition, but they're a much different type of company. They're a much more seasoned company. They've been public for, I don't know, probably almost 10 years or even longer.
They're a little longer in the two. That's for sure.
These guys have best case $607 million. They have more like $7 billion cap, $7-8 billion cap, and Commvault has a 4.8. So that's all
Right.
not super
And
encouraging.
and Commvault to revenue base is, call it almost $1 billion now. I wouldn't be surprised if Rubrik passes that kind of revenue base in the next 2 to 3 years.
The market's pricing
accelerates
that in,
beyond
right? For sure. They're pricing that in. But by the way, just get back. This is exactly the issue we need to talk about, which is the underlying transition. So in 24, they had $628 million in revenue. 86% of that was subscription. That was growing 40%. And one thing that's important to know about the ARR is generally calculated, taking that last month, a quarter of recurring revenue and multiplying it times 12. If that growth rate, you look at the bottom, ARR is growing 47%, that means the growth rate year over year in the last month of the quarter was faster than the quarter overall, which implies an accelerating subscription business, right? Because there can be weird comps, but at the scale, it should be pretty diversified. You can see here now, maintenance, which declined 50% almost, is only 6% of last year's revenue. Other revenue is down 60%, is now down to 8%. So really, you got even that 14% goes to zero, and there's a hole. Like, I still feel like that 30% growth is going to break through based on math.
Right. The thing that I would note here too is, even maybe going back to the previous slide, is Rubrik is effectively the only company in the enterprise software space that's growing faster than 30%. Like, as you look at kind of the enterprise comps today, like across the board at every kind of level of ARR, there are no companies that are growing faster than 30%. Part of that is by design. The market has certainly told companies in the enterprise software space that they need to become more efficient, that they need to get to profitability. And so that's forced, I think, their perspective in terms of focusing on kind of growth at a reasonable price, or growth at a more efficient, with a more efficient operating model. But I think if you look at Rubrik today, if you put in the perspective of growth is still more valuable from an enterprise value standpoint than efficiency, Rubrik is literally the only company in the market that's growing faster than 30%, and they're at scale.
GitLab is growing 30%, 37% next 12 months, and they're trading at 13 times.
I don't know if GitLab is part of the calculus that folks use on the enterprise side. I know they have a ton of enterprise
developer repository, but going back to your religion of, let's just look at the metrics. The metrics are pretty similar in a growth perspective. I had to pull up what they're offering.
And it says here CrowdStrike is also growing faster than 30%, but I think if you take, it depends on who the analysts are, obviously, that you're using, and what the kind of consortium of Wall Street estimates are that you're using. But I think most estimates have CrowdStrike under 30% over the next 12 months as well. Nonetheless, like the average is 19%.
This is by the definition, the average. The analysts on average are forecasting 32% growth for GitLab the next 12 months. So it's trading at 27 times. By the way, they have $5 billion in revenue in 25. So there's a tremendous premium given to companies that have crossed the Rubrik-on and have proven that they have a lasting franchise, right? If you're still small, we've seen a lot of companies kind of putter, right, when they get to $1 billion. These guys are growing 32% at $4 billion in revenue. That's real, right? So people are betting on winners, having an open field and all that. And that's happening with AWS. It's happening. There's always a large cap premium. And so that's a piece of it. But I still going to argue that GitLab is incredibly similar metrics, and they're trading like 50% higher on a revenue basis. So we could dig into their profitability metrics too. But anyway, let's move on. So by the way, this again, we're going to go back to, there should be a relationship between revenue growth and EV to sales multiple. More growth, you pay a higher price. And so our beautiful friends at Clouded Judgment, they do a great service for everyone. Have a free, you can sign up for this. They become the authority on like the non-sell side, publishers, sell-sider of software research. He's I think a CFO of a public company, but they do a regression. They say, look, what this means, this is math. Sorry, everybody. This is going to be pretty fucking nerdy for a second. This is how we add value. But they're saying that on average, if you just take you say that EV to sales is a function of just how fast you're growing. They're saying that on average, you take 32 times whatever that growth rate is. If you grow 10%, that means you're going to get 3 turns on your multiple, and then you add 2 to it. You should be trading at 5 times EV to sales if you're growing 10%. If you're growing 30%, it'll be 32 times 0.3. It's kind of 12 or something. 11 plus 2 is 14 times. So that's how you think about it. And they've got an R squared of 0.4. That's not great. So that's like saying that we can explain 40% of the variation in EV to sales. So this is pretty friggin' nerdy, but if you're going to do valuation, you got to get your
hand. It completely ignores profitability, which some of these companies are much more profitable than others.
Yeah, you've made a very good point. That's another thing. The more profitable you are, the higher. especially growth and profitability should be the two things that drive, the explanatory variables to explain whether or not your EV sales is 20 or 2, right? By the way, so we did our own analysis on our comp table. I asked my quant nerds. We have a team, PhDs from University of Chicago, and they did this regression for us.
We do?
Yeah.
How do I get access to them?
They're off the books. They're off the books.
They only work in Mexico City.
India, too. They had to go back. Their visas ran out. So very cheap. Just the tips. We had the nerds run the regression, and we actually have a much better regression. Sorry, Mr. Ball. Our regression using next 10, 12 months or 2025. In either case, we get 0.7 with our group. I think it's probably because they have a broader sample. I was looking mostly just like SaaS, real software SaaS, enterprise SaaS, things if you squint that are comparable to these guys. And I just have some of these are weird. We get a similar thing where you say kind of baseline for next 12 months is you get 2 turns on the multiple, but it's actually higher. Our multiples, our quants say that you should get for every like 10% of growth, like 5 turns on the multiple, like 52.9. That's what that means. If you're getting 10%, you're going to get 7 turns. It's a nice, pretty line there. Look how good that is. Prediction. The quants are good. And so if you just take, say, 35% growth, the quants say, ignore profitability for a second. The quants say that it should be trading at 21 times if it's going to grow 35%, 27 times based on 25 growth if they're going to grow 30. So if they can grow 35% in 2025, they should be trading at closer to CrowdStrike multiple based on just the sample. They're like, wait a second, this brings so much money. All right. By the way, this is what I was saying before. Like if you look at with 35% growth, this is a little bit stale. Let's say it's trading at 8 times. You get like 0.3 times EV to sales to growth. Like this is really cheap based on the growth metrics. But again, profitability is a problem. Like they had negative 40% operating margins. You look at the run rate of ARR, you take that 784 million and you put in what their annualized OPEX was in that last quarter. I even went that far. And you take what their op margin is based on Q4 ARR, you get like 30%. Pretty bad. Negative 30% sort of operating margins right now. One thing they do talk about though here is, hey, it's going to get way better. If you look at the subscription piece and you look at the cost of that and you take all operating expenses, their contribution margin, which means every dollar of revenue they've added on subscription came in at only negative 12% operating margin. So they're just trying to paint a story in their S1, I think, that they're leverage.
You've fallen for management's trap here, by the way, which I'm going to go through. So management, if you look at this, management uses ARR up top, and then they go into the cost of revenue on a GAAP basis, which is revenue based. And so you're getting credit for all this ARR that, by the way, comes in throughout the year, and you recognize the full thing up top. So if I sell something on December 30th or 31st, I get to recognize the way ARR is defined is I sell that. I don't really get any of that revenue. But if it's $1 million contract, I say, hey, I have $1 million of ARR. Then you go down to the cost of delivering that. It didn't cost me anything to deliver that. I'm getting to recognize that ARR. And so it shows up in this as pure profit. So this is way overstated because a lot of that ARR came in throughout the year and they haven't recognized the cost, particularly in the COGS piece for this. So we'll go through this slide and but I think it's very backwards and misleading of management to throw this out there.
But that's typically how ARR is recognized. I mean, ARR is
ARR is, but you can't say this is the thing they describe it as a contribution margin to say, hey, this business is much more profitable than it is, right? So they're misleading you because they're saying the cost of revenue of this ARR is including COGS. Sure, on sales, I could get that, like behind that, you're selling that, like the cost of sales to get that. But to call it a contribution margin and say, hey, this is what it costs us to deliver this, it's not really fair. It's going to cost them a whole lot more money when they actually have to pay their cloud bills and all the costs to deliver that service. So it's closer to, instead of negative 12, it's closer to like negative 64% is what I came out.
Negative 30 at worst. And I think I'm going to disagree for 2 reasons. One, it's pretty clear. I think that you can, when they're on-prem, they can define what their cost of goods is. And that's what's missing from this is the cost of support for on-premise. And I'm going to argue that it really is pretty much near.
No, so if in the example, you sell something on December 31st, I suddenly have $1 million of ARR. Is that accurate? That just falls straight to the bottom line in this analysis.
Because that $1 million is going to be it's definitely
It is,
coming.
but there's going to be a cost to deliver that service. Is that free? Can I deliver that at zero cost? No, they have gross margins of, call it 80%. It's usually you're missing 20% of the cost.
But that's included in the non-GAAP subscription cost of
No, it's not, because that's an accounting figure on revenue. It's not on ARR. That's the problem.
Yeah, so I think that you're nailing one of the key debates, and so we can let people decide for themselves. But I'm arguing that I'm seeing leverage in the business historically. One big question is they just got a big check for approaching $1 billion, and you got to assume they're going to invest to reaccelerate. And how are the markets going to digest potentially big losses as they ramp? Because I'm going to be shocked if they can take that money and put it to work and immediately get positive contribution margin on that. Like each incremental salesperson you add is less productive for a period of time as they ramp. Real big questions on their guide for like profitability. Yeah. Obviously revenue growth I think is going to be there, but go ahead, Brucey.
I was just going to say, from my perspective, and this is just my own opinion, I think like it's fair to use ARR on the top line, but it's probably not as fair to use it on the contribution level. I think it's fairer to use kind of GAAP operating metrics on the bottom line because those are apples to apples. You can compare those fairly. The thing about ARR that's tough is that everybody has their own unique definition of ARR. They're different for every company. But I think that
there's a reason it's not an accounting term.
Yeah. The thing is though that I would qualify everything by saying I think ARR generally, like if you're using a conventional definition of any kind, is actually the best metric to track the health of the business. I think it's actually better than revenue, which is a lagging indicator typically, and it's better than the operating profile of the company. And so I think like putting everything aside, I think ARR is actually the metric to lever kind of valuation or enterprise value for any company, especially in enterprise software.
It 100% is, but you can't, I guess in this analysis, my big objection is you can't mix apples and oranges. They're taking the best of both worlds. So where they want a big top line, they're using ARR because it's a bigger top line. And then for costs, they're using revenue metrics. So they're mixing and matching. It doesn't work. So I'm very disappointed that this showed up in the S1.
So here's the thing. I disagree. I'll move on. I'm just to get the last words. I still have the conch. I feel like it's pretty simple to figure out COGS and where they go. It's pretty simple to know what the cost to deliver is for supporting people.
But then they should put that in instead of the.
What do you think that 90?
Not for the 784, maybe on the 533.
I'm arguing, that this is. I'm putting 100% of the annualized OPEX in here also. So there's some OPEX there that is double counted in supporting the maintenance and non-cloud business. So I think I've added conservatism in there, but point taken, like there's some new math in here. There's some fake news potentially. You can't blame them for making the best case they can. That these guys, because the real question for these people is
that was the problem with SPACs is they just made their own forecast and they threw it out there. They were less regulated. So like the whole thing about going IPO is you should have some guardrails and people slapping your hand and saying, no, this is not okay. You can't do that. And I feel like this one must have paid the regulators a little extra and their bankers.
Who is on the S1? I bet you I know the analysts are going to be covering this. It's going to be a hodgepodge of former storage people.
Goldman was the lead left on the
lead left. Wow. Wonder if their lead software analyst is going to cover this. Anyway, that's quite a
Goldman, Barclays, Citigroup, and Wells Fargo.
Who is SMBC Nikko? That's somebody's cousin. Anyway, how much Capital One Securities? What's in your wallet? Wow. They probably did it for free. Wouldn't be surprised. So interesting cover. So let's go back to, I tried to be honest with ourselves and say, this is more inside baseball from the Quant factory, that how does the market price like poor profitability? And I ran this thing on 2024 op margins. So it's a little near term. I'm arguing that their worst case is negative 30%. The market in general, based on what we see,
they were negative 50. Now we're giving them credit for 20% automatic, and they're heading the opposite direction. By the way, they're getting worse. So suddenly they're just going to get better. As they add those new salespeople that are less efficient, as you said.
The market traditionally, rule of thumb, prices in about 21 turns for a company growing 35%. On average, they're going to discount that by 5 turns if you're growing at 30%. That would put you at 16 times, not 8. So even if they were at 40, add another turn, you're going to be at 15 times based on.
They were closer to 50 and they're getting worse. Call it. Why don't we call it 60?
I don't understand a single number on the slide.
So very simple, these coefficients, right? So that's saying that if your op margin is negative 10, negative 10% times 17 is about 1.8. So negative 2 turns, roughly, you have negative 10% op margins. So this market is saying that, but by the way, you get more credit for growth. This is saying that for every 10 points, you get 6 turns. On that, that's what that 60 means. Ignore all that shit. At the end of the day, the conclusion is we should be discounting this by 5.
Even if I were to take Georgie's most bearish scenario of negative 60% op margins in 24, seems kind of a stretch. That would be, roughly, double that 5 turns. It might be, 10 turns of a discount. I would go from 21 times to 10 times based on that model.
I can't get below 10 times no matter how I do this. That's my point. So that's a lot of math. People are probably getting shivers and traumatic flashbacks. But if you were to value this thing, even if it's going to go 35% next year, if you believe that and it's trading like 15, 16 times, this stock should be a double. It should be a 70, not a 36. That's what this implies. And again, like that would be at 5% growth, like 0.6, 0.7 times the sales growth, $70. It just doesn't make sense. But the market is telling you we're really worried about losses, or this is really a storage company. I'm going to touch on a couple other quick things that I think are interesting.
Oh, you're trying to give them the AI hype multiple.
Yeah, the thing is,
got lots of data they touch. Lots of data. Imagine what we can do with AI.
They're going to put a protective layer around all your ports, around all your glory holes, so that when you stick in your data, it's not going to get chopped off. This is from the release. Secures a private entry point into generative AI. That's friggin' weird. So we're just like an AI condom.
Right.
You're like a whole
2 extra turns.
So I guess it's the interesting security risk. I read this. There's like a bunch of problems where people are like, when they access ChatGPT, somehow they're creating a vulnerability. Like that didn't make sense to me. But main thing is like
you are actually.
Yeah. So we're using Azure from using OpenAI for threat intelligence, to figuring out what happened or to identify threats. We're adding this really incredible intelligence layer from OpenAI into the embedded Rubrik. They call it Ruby. But what I thought was interesting is they also said that they're going to drive go-to-market activities with Microsoft. So I feel like they're implying that these guys at Microsoft might spend some money to promote their solutions with Rubrik. And they had also invested in Rubrik in 21. So Microsoft, this is classic self-dealing, right? There's a lot of Microsoft invests in a company, and then the company says, okay, we're going to commit to spending a bunch of money with you. So they're going to spend $220 million over the course of 10 years. It's actually not that much money. Hey, it's something to think about. It's an off-balance sheet kind of liability, but I presume they've got customer commitments to store data that cover that. So I feel like that's riskless. But they have a really big brother helping them and validating them. I think this is going to help them cross the chasm to go from that $1 billion company to a $5 billion company, so that they can be like CrowdStrike and all these companies that get a big multiple. I'm going to give Georgie credit for this. This is the Charles Lang Supermicro plan. Like basically, hey, investors, guess what? If we do well, our CEO is going to get really rich. And so he's really motivated. And so that's why you should buy us. And it's pretty amazing. But again, this guy's he's aiming for the moon. He's aiming for 7X.
This is like the Elon stock package, or what's the gentleman at Supermicro?
Charles Lang Tan invented this, I think, and validated it. Like, made a whole bunch of investors rich by making himself rich. But holy shit, man! These guys are like, to actually put this in writing. Like, this stock goes up 8x. We're going to get this many shares. And this guy is not satisfied with his IPO money. Like, he wants to be a billionaire.
Yeah, 100 millionaires are so yesterday.
Yeah, man. I mean, especially given what dollars are worth, these going to be worth. Scrooge McDuck kind of situation. But yeah, I like that. Historically, this has worked. But to conclude and hand the mic back on where we are, clear momentum in the end market. These guys are going to cross the chasm and going to be a player in security. That upper right quadrant is a great group because they are way bigger, maybe with the exception of Cohesi, who I think got bought by another big player. Are accelerating faster than revenue growth. So this is an accelerating business. They just got a bunch of nitroglycerin, bunch of nitro, like their founder. He was cracking nitro pills into his nose. Clear path to profitability, in my view, because they're already doing 12% contribution margin.
Clear path, even though they're heading in the wrong direction right now. The trend is the opposite. That's all right.
The margin. They're too cheap. Even if you account for the recent losses, it's way too cheap. And you have this big brother with a big wallet. OpenAI is just not in the multiple. I'm ready for you to take care of me here. Brucey, tell me what I said wrong. Tell me why this is a short. What am I missing?
There's lots of things you're missing. So I think like a lot of the companies, as I'm pulling up my deck, A lot of the companies that we talk about, I think they're good companies, right? You got to separate the company from the stock as well. And so I think Rubrik is a leader in their space. I think they are clearly have executed better than a lot of the other storage companies that secure and back up your data by adding kind of the layers of software around ransomware. And that's resonating with customers, right? We see it in the higher growth. But I would say when you think about the stock itself, right, there's definitely a higher valuation than who they call their competitors. And we can argue whether that's the right comp set or there's a different comp set that's better here. But the things that worry me a bit, and I'm going to get to them here in a second, and I went with you made the joke about, I could have made a Rubik's Cube joke. So here's my Rubik's Cube joke. I've got a Rubik's Cube solving the Rubrik puzzle. The problem is all the metrics, even though they're robust, they're all going in the wrong direction. The growth is going in the wrong direction. The NDR, the net retention, right? What customers are spending has been fantastic. It's going in the wrong direction. Their sales efficiency, it's going in the wrong direction. So here's my hungry bear licking his chops there. He's ready to get in.
George, sorry. In terms of when you say wrong direction, like obviously as a company gets bigger, like all of these metrics tend to flatline in some ways. Like they stop. Just the law of large numbers means that they slow down. They don't necessarily go into the opposite direction, but they slow as the company gets bigger. Growth is probably the best data point across every enterprise software company, maybe every company, right? That slows down over time. Just to qualify, when you say wrong direction, are they going opposite to where they have been historically, or are they just slowing down as the company gets bigger?
Yeah, we'll get into that. One of the things I do look at, there is laws of large numbers, right? So if you're a $10 million company, it's a lot easier to grow 100% than if you're a $100 million company, right? So to grow 100% at 10 million means you're adding 10 million to your top line. To grow 100% at 100 million means you're adding 100 million to your top line, right? The bar gets, the larger and larger you get, the harder it is to grow those large numbers. So it's very fair. So I do tend to look at, you expect the growth percentage to come down. I also do like to look at the absolute numbers and say, hey, are these guys still generating more ARR growth on an absolute basis? And then what does it take to generate that new ARR growth? Like that to me is always a key conversation is, are they maintaining efficiency of selling? So if I get, for every dollar of new ARR that I get, how much is it costing me to get that? And if that's saying stable or improving, that's a great sign, right? But if you're having to spend more and more to get that same dollar of ARR, that's a trouble sign. That means you're having to work harder, you're having to spend more for that ARR, and that is not a good sign for your business, because generally it means you're getting saturated, you're having to reach farther into less ideal customers. You've picked a lot of that low-hanging fruit on the tree, and now you're having to get out the ladder and climb up, and it's not likely to change. So that, to me, is one of the big things that worries me here. So it's slowing growth and net retention. We talked about the unprofitability and burning cash. That kind of goes into what I'm going to talk about on the worsening sales and marketing efficiency. And then finally, the debate a little bit on, do they really deserve like a security multiple here? Or should they be closer to some of their peers and competitors that they outline even in their S1? So let's go through that. So I think I started out just to say, hey, why is Rubrik intriguing? And this is a chart that Meritech Capital put out, and they actually do a great job. If you've never looked at their stuff, they will take S1s and do a whole write-up on them. And so I left in some of their commentary here. But they looked at some of the best of breed companies that have come to the market, and early on, same stage, like how did they grow from 300 million in ARR to 750 around where Rubrik is today? And how does Rubrik stack up against those? So you have companies like Salesforce.com, Bill.com, CrowdStrike, Zendesk, Shopify, HubSpot, Klaviyo. You have all these great companies that have been fast growers. They're right in the middle of that mix as it's plotted out here. And so you say, wow, this is intriguing. And those are all companies that have traded at huge multiples, have grown, continue to do well in the public markets. And so it feels like they're really well set up. The one difference Rubrik has versus these guys, though, is they had an installed base. And a lot of that ARR growth has come from converting what was already perpetual sales. And all these other guys were cloud first from the get-go. So they had an unfair advantage to drive this growth. And so that's just something to keep in mind. I'm not going to knock it. It's great growth, but end of the day, like they had an unfair advantage. So I wouldn't put them necessarily in the same era as these guys, given that advantage that they had.
Never heard somebody describe an on-prem transition as an advantage, but okay.
No, I'm just saying, like, end of the day, I don't think they're at the same category as those companies. And so I think it's easy to look at this and say, hey, their multiple is lower than some of these top tier companies, but they've grown just as fast. Look at what they've done. Keep that in perspective, right? It's not, they had a advantage there versus those other ones are out getting new customers, which is much harder. It's so much harder to get a new customer than it is to sell to an existing customer. And so that's one of the big challenges.
They were founded, I think, in 2014. They're pretty new. This is not EMC.
No, but it's easier to go to your perpetual. They stopped selling the perpetual licenses. So they, in fact, forced the transitions. You could churn, right? Or you could actually become a subscription customer. So they didn't give customers a choice. Now, customers could leave, but that's hard to do. So I think that's something that's benefited them quite a bit. But again, growth is growth. They have the customer base. So I'm not going to knock it. It's just something I call out. But this is, to me, here is plotted their subscription ARR and year-over-year growth. And so what you saw in 2022 is this is a company that was growing ARR at almost 100% clip, 96% over the year. And they peaked really, I guess is that October, July, at 114%. And then it's been a straight shot down to the 47% that they find themselves today. And when I go back and I said, okay, the point I just made, they had some of this on-premise growth. That was probably inflating 2022 as they converted folks over. 17% of their growth was from those transitions. So even if you take that out of the 96% and adjust, you get 79% growth last year. And this last year in 2023, 2020, or what they call their 2024, is really, and I think I have a couple of my dates here mixed up between 2022 and 2023. But what they have here is 43% growth the next year when you back out 4% that came from the on-prem base. So most of that conversion is done. There's none left. So you went from like pure organic growth of 79% the previous year to 43%. That's a huge drop. When I see drops, like I expect, okay, you lost 10% in a year, fine. But this is like a falling knife. And so here you're catching the falling knife of ARR growth. So it's impressive. They're higher than everybody else. But if this trend holds, every quarter, they're losing 10 to 15% right now of growth rate. So that's a very concerning trend if I'm thinking about investing in this. You look at what they're doing with existing customers, and I just made the point, hey, it's easier to sell your existing customers. And so one of the big stories here as well is net dollar retention. And that says, if I am a customer, an existing customer, and I spend $1 with you the previous period, what am I spending in the next year? So if I'm spending $1.10, then as a company, my net dollar retention is 110% because I grew you 10%. They have had best of breed, I'll call it net retention dollars. So they were averaging in the 140s here in 2022 and 2023. It's 140s. But this also is starting to look like the overall growth chart. It's falling and it's falling fast. So we go the last 4 quarters, they were 149, they went to 146, 140, 133. It seems to be accelerating to the downside. So customers are getting saturated here. But I will say it's still a great number.
Yeah, I was just going to say, I think if you look at this chart on kind of an absolute basis, the trend line could be concerning. But if you look at this chart relative to the broader enterprise software universe, this is still kind of a premium number in terms of where you would expect enterprise software companies' NDRs to be. And this is a company that's at scale. So even like taking their numbers, for example, call it they're at 700 million in ARR, they would walk into the next year with almost $200 million accounted for just out of their current installed base, which I think like on an absolute basis, still relatively strong. And even though the trend line is decreasing, the trend line will decrease for almost every company over time, right? As their revenue base gets
Not
bigger.
usually this fast, though. This is a pretty fast decline, but I will agree. I think this is less of a problem than their new customer traction, which is something I want to get to. And I think that is the biggest predictor of future health is, are you attracting good new customers? Because that's where you're going to get your future expansion from. That's where you're going to grow from. End of the day, like this will tap out. And are you getting good new customers? So let's come back to that. So this is less of a concern for me than the previous chart of just overall ARR growth, which is really suffering because their ability to attract new good quality customers. So I make the point here on this slide. This is just their S1 showing 2023. And by the way, their fiscal year ends in January 31st. So 2023 versus 2024. So their net loss of 2023 was 277 million, and it goes to 354 in 2024. So worsening profitability here. And then on a cash flow basis, right? So you can say, that's GAAP accounting. Cash flow doesn't lie. Free cash flow also got worse in 2024. So you have falling growth and worsening profitability at the same time. But usually if you have worsening profitability, you say, oh, they're investing for more growth. They should be accelerating. That is not the case here. They burned 15 million in free cash flow in 2023. In 2024, they burned 24 million. And at the operating level, it was a difference of 25 million. They actually generated 19 million of operating cash in 2023. That went to almost negative 5 million in 2024. So big difference here.
Put it in perspective, though. This is a company that's doing almost $800 million in ARR, burning $2 million a month.
Yeah.
I mean,
but they were profitable. And right, again, if this wasn't with slowing growth, if this was with increasing growth, I would understand, but they're not turning the corner here, despite what they're saying on their.
But also, just for the audience, this is a real cash flow number. And as you think about what a fundraise means in the context of how much they're burning capital, they went out to the market and raised several $100 million of capital to put on their balance sheet. That balance sheet gets depleted by this cash flow number. And so as you think about the runway, for example, for a company, which isn't as relevant for a public company of this scale, but as you think about smaller companies, it could be relevant. This is a company that has several years, if not decades, of runway just on these numbers alone.
Yeah, no, I'm not saying they're going to run out of cash, but I'm saying they're not efficient. And it seems to be a problem that's getting worse, not better. So
that's not rewarding companies that are burning cash and are not profitable. We're now in an environment where that kind of matters. It's amazing these guys did this, that they went public in this environment. Like when somebody goes public in this environment, there's got to be some desperation in there somewhere. Like the VCs want liquidity, or these guys want more money and they can't go back to the well. They want a currency for acquisitions. There's a lot of reason to do it, but I got to wonder what signal we're getting that they decided to go get public money now. And they did get pretty decent multiple considering how much they're burning, but I got to question that. Like, why go public now?
Yeah,
You know?
that is always a valid question. It seems like you're coming over to the bear side, Gordon.
I'm just being intellectually honest.
I can't figure out what side either of you guys are on at this point in the conversation. I would say from my perspective, this is a company that's raised a ton of capital. It had a window to access the public markets. It obviously was an oversubscribed offering, and it gives everybody on the cap table a ton of liquidity, right? And I think it's one of those companies where it has the scale, it has the operating profile, and it has an investor base on the public side that's willing to support a multi-billion-dollar valuation. So it's early maybe to go out.
And they have a deteriorating new customer acquisition that they need to quickly sell some stock before the whole thing falls apart.
That was not very nice.
All right. So this is where my friend Gordon here, Mr. Gecko, was pulling from the S1. So the subscription ARR contribution. So we talked about this a little bit. I don't want to completely beat this to death, but there is a mismatch, particularly on the COGS here. So they're giving themselves credit for an ARR number instead of a revenue number that they're delivering those COGS against. And if you actually take their subscription revenue and match that up to the COGS, the subscription revenue number is going to be what they actually recognize during the year. So it's more matching the timing of when those deals were sold. You get a much more negative margin. Now, I will admit it is heading in the right direction. In 2022, according to my calculations, they were at negative 127%. 2023, negative 90. Hey, we're almost there, guys. We're only burning as much cash as we make. What's
Just back
that?
up. What do you in the lower right chart? Just to be clear, that what you're doing, you're just taking the actual subscription revenue instead of the ARR. And that's what you're
Correct.
doing to get those numbers.
Yeah, and because the subscription revenue matches the subscription COGS. So if you're going to use subscription COGS, right, that's actually what it costs to deliver that revenue. Those two need to match in period. And so that's the difference, right? But they're heading in the right direction. But it's still, negative 12 makes you feel like they're about to turn the corner. Negative 64% says you still have a long way to go, right? They burned $342 million on the subscription business in 2024 per GAAP accounting. So it's a much different story. And I think using that other number, again, is unfair because you're saying, hey, if I sold something at the end of the year, I didn't generate much cost on COGS for that, but I'm going to give myself a full year credit of top line. And that just didn't happen. So it's an intellectually unhonest, and there's still a big gap here in profitability, which is why we see those numbers still suffering. So this is where I really put pen to paper here, and I did some work. So for me, as I mentioned, you want to see, it's great to have a high net dollar retention, getting your customers to spend more, and that's really carried them quite a bit. And I want to see, what are they doing? Are they continuing? Is the engine continuing to drive new customer growth that are going to spend in the future and continue that high net dollar retention and expand? And so one of the things they didn't disclose what this has been historically, only the last 2 years, but what are the number of customers? Are they growing customers? So they had 5,000 customers in January of 2023, their fiscal year there, and that grew to 6,100 in 2024. 22% customer growth. That's good. I like that number. I don't have historics to compare that to say, hey, is that improving? Is that getting worse? But 22% feels very strong to me. And all right, good job, guys. However, their sales and marketing expense. So it was $418 million when you go and look at 2023. When you jump to 2024, it goes up to $483 million. So they're spending more. They're a bigger company. They're trying to get more customers. What you want to understand is, what are they driving with that investment? And so when you look at their ARR, you say, what is the new net ARR? And so we were talking about, are they, growth rates coming down. It came down from 96 to 47% their ARR. But what is it doing on an absolute basis? Their net new ARR in 2023 was $261 million. Guess what it was in 2024? Oh, it was less. On an absolute basis, their net new ARR went down by $10 million, $251 million. And they spent more money to get less new ARR. They spent $483 million to get $10 less million in ARR than the year before. So they upped their spending by almost $70 million to get $10 less million. That is not a sign of health, friends. That is a sign of trouble. So what does that equate to? One of the things that you look for in sales efficiencies, you think about payback. That's one of my favorites. Okay, if we sell these customers, like how long does it take to pay back that sales and marketing investment? So in 2023, that was 1.9 years. For an enterprise company selling an enterprise, that's okay. Hopefully you're getting long contracts, 3-year contracts. So you say, okay, we have a line of sight to like paying this back before the contract is done. And you want to see that come down over time, or at least stay steady. With that worsening sales efficiency, it went from 1.9 to 2.35. So now, like 3-year contract is very long for most companies. Maybe you're getting payback on these deals, maybe not. And so that's starting to get questionable. It's heading in the wrong direction. So that's very concerning for me. And then when I look at these new customers, that customer growth was healthy. So why is this payback getting worse? Well, if you back into the ASP for these new customers, they're teeny tiny customers. So I think they're having to reach into a smaller customer base than they've sold into historically. They're landing small deals. So the average ASP is $68K. Now, we don't know historically what that has been for new customers, but it definitely felt lower, because if you look at their total, you take those customer numbers and you say, what for their whole entire base, their base that's expanded, give you that over time. What has that historically been? Well, in 2023, their average was 119K. If you now add in those new customers that they brought in 2024, and they were bringing in new customers, right, in 2023, it's down to 102. That's a big drop across their entire customer base. So I think what's happening is these guys are finding it harder to sell, harder to land new customers. They're having to land smaller customers than they've had historically. Maybe that conversion from their base. A lot of on-prem customers who like those perpetual licenses, they tend to be big customers, more security conscious. Now they're reaching and they're having to find that higher or harder tier to sell, and they tend to be smaller. And so the sales efficiency is really taking it in the pooper here, unfortunately. So
Oh my God.
that to me, like,
door. All right. Look at the economics. Right?
I just don't know what else to call it. Like,
Yeah.
to me, this is a screaming bad sign.
All right, let's talk about this
Is,
first. I'm sorry, go back. Just one thing, so we can just make sure I get this big picture, what you're doing here. But like just unit economics, the way you're doing the payback period, I think, is you're saying what's the incremental gross margin at 80%, those dollars, or the payback period, like how long does it take to pay back your total S&M expense based on how much gross margin you're producing incrementally? Is that what you're doing?
Yeah, from the net new ARR, right?
Yeah, I think it's just interesting. It's high level. I agree. Some numbers are going the wrong direction, but just thinking about this, they added their S&M expense. You're saying they spent $483 million, which incrementally is like $65 million, right? So you spent $65 more million to get $251 million in incremental ARR at 80% margin. So call it $200 million. To me, that doesn't look so bad. So even if they're going down, unit economics are pretty good. I don't like those numbers are going down.
Well, here's another thing that puts into perspective, though. I mean, if you have those customers trying to expand, if their average new ASP is 68K, if they expand at the 130% that they had last quarter, like you're only getting 20K more on these customers. Like you're not getting a big amount. They're smaller customers. They're not as robust. And so it's going to hurt your net dollar retention going down. And the one thing I should have hit upon, so I'm glad we went back to this, is like when you look at their net new ARR of 251, most of that is coming from existing expansion. And that's why we get down to this really low ASP. So if I take their NDR from last year and I had to do a little bit of math, your implied new ARR from new customer, 24 million or 47% of net new ARR in 2023. In 2024, this falls to 75 million or only 30% of net new ARR is what floors me. If you take those net dollar retentions throughout the year, call it 140%, and you expand, that accounts for the majority of that 251. Counts for about.
But there could be an issue there where it's suggesting it's too small. But I don't know. You're doing a lot of math here, which I appreciate, but there's also a lot of assumptions, I think.
The
Most of
implied
it's based
ARR
on pretty
part-
hard data, but sorry, go ahead.
Okay, sure.
I was the implied ARR from new customers. That's where I think a lot of the analysis hinges on, and so that's I think the biggest question for me. But then also the new ASP, is that a reported number from the customer or from Rubrik?
No, so it's backing into so they report the new customer count, the 1,100, and if you take that implied ARR from new customers, that's 75 million. So that's where you get the new average ASP. And they give you total customer count, so you can also look at the average. I say average revenue. It's really average ARR per customer, right? Which would be 102. Yeah. So that's definitely coming down from before. The trends, I think this all does line up. But if you take just to do the quick math on the new ARR, I can break it down for you.
That's the biggest question. Because most of the time,
call it 140, right, on NDR. We looked at that chart earlier.
Yeah. Yep.
Right. And so if you take that on the 533 and say 533 is going to grow 40%, right? So what's 40%? It's over 200 million, right? And they had net new ARR of 250. That's the majority of it. You're left with about 75 million from new customers. That's the rough math. So the math checks.
I'm trying to find how they define subscription ARR.
Most of the time, you don't see companies where they have an ASP across their customer base of six figures, in this case, $100,000, but the new ASP be 75% lower on average. That almost never happens.
Yeah.
And then the expectation is
I got it.
that those customers would triple basically over time to be an average kind of size customer. That's the thing that I wonder if we're doing kind of the implied ARR correctly, because that's just such a big delta.
So just real quick here, just the definition that they're using is actually a more worrisome definition from my perspective. They say it's calculated based on the annualized value of our active subscription contracts as of the measurement date. So to your point, if they get $1 million contract on December 31st, that's $1 million in ARR. And so that's actually more aggressive than other companies I've seen that take just the last month actual revenue times 12. These guys are leaning into this for sure. So that's a little worrisome. That kind of validates some of the work you're doing there, Georgie, that incremental ARR doesn't look great for new customers.
Yeah, it's good work. And so back to the question of like, why are they IPOing now? Maybe they've picked the low-hanging fruit and it's, guys, we have a much harder slog to keep growing the way we've been growing because we got to start with smaller customers. And their business model, like we saw it right in the NDR numbers, like it leads to the more data you store with them, you're going to spend more. So I do agree these customers are going to store more. I think they're just having to go down market and sell much smaller customers than they've had historically. And I think, again, some of that may have been they're benefiting from that on-prem base that they had that tend to be larger customers that want to be on-prem. Now they're hitting smaller and smaller customers. And yeah, they'll grow, but it's hard to grow 3-4x to get up to where they've been with these other customer bases. And that's also why probably the NDR is starting to fall off is your next tier of expansion customers are starting so small. They're smaller customers.
But the thing is, I look at their data, so from their S1, so if you look from January of 23 to January of 24, they added 500 customers that were the subscription customers with over $100,000 in ARR. That's basically half their new customer count.
That could be, they're just saying customers that spend that much, right? So that could be their existing base. It doesn't have to be new customers.
So this is important. What NDR did you assume? Because if you just look at weighted average of the 4 quarters last year, it's going to be way higher than 133, and that's going to really depress how much you're contributing from new customers. What NDR did you use?
I just took the average of the 4 quarters, right?
So it's probably like 200 or something, and that might be wrong.
No, it's like 140. It's in the, I'll
okay,
say what that number is.
I could accept that. So you're basically saying that your new customers are going 40%. If you back that out, that sounds reasonable. If you're using 180, I want to argue about it. But 40,
yeah,
140,
my average, what I calculated was I used an average of 142.
Okay,
that's what I used.
I can live with that. The real question here is, will they grow 35% or not? And I get your concern, but if they can grow 33%, I think the NDR is going to be down when they report it. But where's it going to bottom? I think it's going to bottom definitely no lower than 120. Probably going to bottom 125. So you've got 25 points of growth on the subscription side without doing anything. The question is, can you get 10% growth from that? Instead of
and their new customer engine is broken, right?
Yeah,
if this continues,
you got to do 80 million in new customer growth or something, net new ARR for this to make sense. But hey, they've got $1 billion or close to that they can spend.
Well, they can spend, but it's not going to be money well spent, right? Like that payback period is going to continue to get worse if they continue selling like this. So you can spend more money, throwing more dollars doesn't necessarily yield a more efficient. That's the concern to me is just, I think they're getting less efficient. I think that's why you're seeing the multiples that you're seeing here, that you're looking at the past growth and you're saying, gee, these guys look cheap. I don't buy that the future growth holds up here. We could probably, if I had more time, I would have played with more scenarios and said, okay, what do I believe that would look like if this trend continues? Where does that growth fall in 2 or 3 years? I think it's going to be with the rest of your SaaS cohort here or lower, right? If this continues. And so the question is, can they really turn around that new customer growth? That's what you're going to depend on. That's your lifeblood to be more efficient, land bigger customers. And if you can, then this thing is a bargain. And if you can't, I'm cautious. I'm not jumping up and down. I was more bullish coming into this before I did this work and saw this analysis. Now I'm truly worried for this company. I'll end just here on the metrics. And you did a lot of analysis here, and I just looked at the 2 groups. So the top group is who they list as their competitors. They tend to be more in the backup space. They are slower growing today. We talked about Commvault. They are trying to change their business. Where they reported ARR growth, I did throw it out. So the 2 here that are probably the best are Commvault, which is growing just a tad under 20% on their ARR, and then AvePoint, which is another kind of SaaS application backup company, growing 23%. Their forward multiples are the 4 to 5 range there. I can give credit to Rubrik, a premium to that, but to me, it's more 5 to 6, maybe 6 to 7, because I just don't believe in the future growth is going to be that much higher. which kind of puts them where they are in the marketplace, right? Like they're already trading there. So I'm not too excited about the upside from here, especially when your metrics are going to be coming out and reporting lower and lower. I think the market's just going to sour on that. So that's the case for staying on the sidelines here for Rubrik and letting the bear roar.
Yeah, I think the real question here is this, we have some good bad examples, like Nutanix, right? Came out and was range bound, but now things are getting a lot better. But like this stock has basically doubled since the IPO over a number of years. So it's not really doing well versus the market. Pure Storage, there's less storage names that have like quick subscription businesses that have come out and they just never got escape velocity, or it took them a long time. But what makes me feel better about this is they've transitioned almost all the way to cloud, and that's going away. And we're going to be nakedly exposed, what stays in Vegas, to subscription growth, and that's a good thing. So the question is, how big are the losses going to be, and are they really going to grow 35% consistently? And when do we? I think I can confidently say they have enough evidence to say that they can get to profitability. We're not going to do a dilutive equity raise ever. I don't think they'll do a raise when their stock is like tripled. Like they don't need cash, right? I don't think they're going to need cash. If they wanted to start firing salespeople, they probably would still have subscription growth. So I feel like it's not that dangerous. I feel like this is more Nutanix a couple of years later, 3 years later, at a better IPO because of it. They waited longer than Nutanix did. Nutanix was like smaller when they came out, and they were range bound for quite some time and went down a lot for a while. So I don't know. I think I'm leaning. Who are the best stories in this space? Who can we look to? It's more like security names like CrowdStrike. That like, is this CrowdStrike or is this Nutanix? I think they're more CrowdStrike. I don't know.
But CrowdStrike is better growth.
I think they'd be happy becoming Nutanix or CrowdStrike. Nutanix is like a $15 billion company today, and CrowdStrike is like an $80 billion company. So I think it's a.
Nutanix had a tough winter, right? They went down. They got cut in half. They were nobody. They were a storage name for 4 or 5 years before things got better. And things are better now, but like it wasn't an easy road. I mean, you bought the IPO.
It wasn't an easy road. They're definitely beneficiaries from the VMware's acquisition. I will say on the one point though that George you brought up earlier. So I was looking through the S1 a little bit, and it says I think your numbers are maybe like directionally correct, but it says subscription revenue increased by $153 million or 40% in fiscal 24 as compared to fiscal 23. Approximately 41% of this increase in fiscal 24 was from sales to new customers. And the remaining increase was attributable to sales to existing customers. So that number is actually closer to 60 million in subscription revenue to new customers, which is double, still low, right? It still means like
still half of what it was previously.
Right. So the ASPs are still lighter than, so it's probably closer to the ASP. The new ASP is probably closer to 50,000 as opposed to 25,000. Still smaller customer, still a weaker print compared to their average selling base, but it means that the kind of implied ARR from new customers is a little higher than 27.
If you go to their website,
maybe it looks like that 41% is revenue, not RI. I don't see how they get there with their figures. I did do some rounding because I don't have the exact base quarter by quarter, or maybe I do, and I can do more work to get it. I'm still confused on how they get there, but regardless, I would say like they spent more. Look at the net new ARR, so that's concerning. They're driving less new net ARR on an overall basis than they did last year. So that's not this is your growth engine. So on an absolute basis, like it's going down, and they spent more to do that. That is still a bad sign. You do not want that in your growth company.
Listen, the splash for going public, they being the only IPO that's public, and all those sell-siders, man. But I feel like we probably got a nice pop here, and then it's just going to be disappointed by their profitability discussion. But they're not stupid. And the CEO's incentive, he's got this chart saying if he increases the stock 7x, he's going to get paid. So that makes me feel better. But I struggle with this. You go online, their illicit ASP on their website for like the starter package is $100K. Like, that's like a number that's coming out. The initial starting cost for Rubrik is like $100K. So even $50K seems really low. And so I think it's a good question.
Enterprise sales all the time. It's not uncommon to discount 50%, right? That's not
they do it for the first year too. A lot of times free for a first year, really low first year, and then it goes up. So maybe that's what's happening is they're getting them in the door, and then data gravity is so high that ASP is going to rocket. But I'm not super happy with this new ASP. It doesn't make sense to me based on what I see on the internet. It seems like 100K is a standard entry setup for Rubrik. So I don't know.
I think so. I think since we've been talking for 2 hours, I'll give my perspective.
We're
on
best
the- on the
friends.
company.
We could chat all day.
My perspective is honestly, like, I think both of you had really good points on both sides. I came in, I would say, predisposed more to being bullish on the opportunity, but I think George did a good job of neutralizing my initial thoughts, at least based on the decrease in ASP, the absolute decrease in net new ARR this year. It seems like below the surface, the company maybe isn't as performant as it looks at the top level. I will say, though, that in this space, this is probably one of the better companies or better names from just an overall growth profile standpoint. I think the company, like all of kind of the warts underneath the surface, are being reflected in the multiple today. And I think as I think about the risk reward here for the company today, it does feel like there's more opportunity to the upside than the downside. I feel like most of the narrative around storage and most of maybe the data around declining ASPs has been reflected in this multiple. And so I think my view is still bullish. I would say in the next 12 months, I would be a buyer of the company in the next 12 months. But I would say my upside here is tempered. Whereas I probably came into this conversation thinking that this trades at around 7 times and the upside here is closer to 14 to 15, maybe closer to where CrowdStrike trades. I would say the upside here is closer probably to 10 times, 9 to 10 times maybe. And so I think there's maybe more modest upside in the name today as I think about some of the growing pains that they're experiencing here post-transition from on-prem to cloud, post-transition from perpetual to subscription.
So it feels in the boxing match, as I like to think of this, is it feels like you came in cheering for Gordon here to knock me out, and I think I held my own. Is what you're saying?
Who is Mike Tyson? Who is Logan Paul? I think I'm Mike Tyson. I think I am the oldest and shortest.
Old
right?
and battered. All right, I like it.
Yes, I'm tougher than nails. I'm the cockroach of the industry. Anyway, do you have any more slides? I think we're concluding.
No, so I'd be curious to hear, Gordon, where you're landing as coming out of this, your true view.
Wait, then not stop recording. I stop sharing, George.
Yeah, I'll stop my screen sharing.
But it sounds, I guess the question is, I think we got a verdict there from Brucey. Like what you're saying now, if you think it's a 10 times is a fair multiple, you're still bull.
I'm a bull, yeah. And I think that,
you're buying.
I'm a buyer. Yep.
What about you, Georgie?
I think the industry will pump this up. I think, as we know, like most sell-siders will come out as a buy on this, and especially those that were broker runners. There's no conflict of interest there.
I will take the over 100% buys. I bet you all of those companies are going to put a buy on.
There might be an analyst looking to make a name for themselves that wasn't on the book that'll cover this and point out.
I'm thinking everyone on the cover, and those guys can publish anytime, by the way, and they haven't. Somebody
haven't yet, but I think I think these guys will get pumped up. Usually, the first quarter out of the gate, like they save some magic. So I think like they'll get a temporary pop, and people argue it's cheap. So I think they'll do okay. And then I think unless they can turn around the metrics around efficiency, sales efficiency, and reignite that like new customer acquisition, like over time, I'm not super bullish here. So I would say they're more fairly valued. I was initially looking at this. I was like, oh, maybe I just nibble on a little bit and buy some. And I started doing the analysis and I decided just to sit on the sideline instead. So I'm not going to touch it because of that. So I'm
buy, like you're basically gun to head, you would buy.
I think the market psychology, I'll differentiate the two. I think the market psychology will drive it up in the short term. It's going to have a lot of positive things coming out, like most IPOs do. Again, a good quarter, analysts saying good things, their customer day, etc. And then I think over time, I think the results, unless they can change something in that business, like if it continues, like I think it's just going to show its true colors. So I'm not going to buy for a short-term market psychology pop. Like I'm just going to stay on the sidelines. So I'm
had to buy. Where does the stock trade in May of 2025? 12 months from now. What's your view?
I think it'll be lower.
Whoa! I think, is that a market comment? Let's just say the market's kind of okay. Like how much of that is bear market?
Relative to the market, I think relative to the market, it'll underperform. How about this? It'll underperform other SaaS names If we took like the cohort of
No, we need to do this on an absolute basis. Is this stock going to be trading lower in 12 months or higher in 12 months?
Yeah. What I didn't have time for was doing my forward projections. So let's say they grow ARR at 30% or 20%.
That's not going to happen with an ARR 133.
Another 210. They're $1 billion in ARR. Let's give it, like I said, maybe a 6 to 7 times multiple. It'll be $6 to $7 billion EV, which is what, roughly where they are now?
Yes, they're more like 7 or 8. Yeah, I think that you're wrong. I think the stock's going to be 50. I think the stock's going to go from 36 to 70 and then to 50. That's what's going to happen. But I can easily see, like Nutanix, if they have a $15 billion valuation, I feel like that they're going to get there. Like I'm going to go long this guy and short Nutanix any day.
But do you think growth is going to accelerate? Like growth is going to keep going down. The NDR is going to keep going down. All those SaaS metrics are going to keep going down, right? They might have one good quarter saved for post IPO where they're going to do something artificial. They're going to pull forward some demand because you always want to have the first quarter come out good. And then I think you're in danger quarters 2, 3, 4 quarters out. I think they're in danger to really crap the bed here, to be honest with you.
I mean, this game theory, you get the CEO that owns a lot of the stock and is incentive for the stock to go up. And so he's like thinking really hard.
He's got a long time period.
Yeah, and he's going to go in there. What's he going to say? You think he's going to the worst thing he could do? I think they're going to guide decent growth and beat revenue by a mile. If they don't do that, they should all go to jail. But if that's the secret contract, right? Like everyone has to beat coming out of the gate. And if you don't, you've broken the court of silent contract with investors. So they're going to do that. The question is, how much investment are they going to sign investors up for? And I've seen a company do that, and they were down 40% that day when they came out after the IPO and said, we're going to invest more this year than we thought. And they don't have any I don't know what the models say. We didn't define what the IPO models say. I guess they can't legally share it with us, but like they told investors what it was going to be. And the question is, are we going to be shocked at how much they're going to spend? Is it going to be negative 80% op margin next year? That's my bear case. But I don't think the CEO is that dumb, right? Like he's not going to give him a bunch of bad news. So I'm already tempted to buy some calls.
You can only pull forward so much demand. Eventually that game runs out. It's just a question of when in my mind versus if they're going to play a little bit of the game here.
I'm a buyer, gun to head. Bruce is a buyer, I think gun to head. So I think the official podcast view is buy in the near term, but some concerns about where the stock goes in the long term. But I think we have to call it a buy. And we change that later. I think for now it's a buy going into the print. Fair? That's my vote.
I mean, that's where my head's at. Look, I think we touched on everything. There are definitely some concerns. Like this isn't just a complete no-brainer buy, but I would say growth, margins, multiples, the NDR just generally support a stronger intermediate story here. And I think feet to the fire, I think in 12 months they trade higher where they are today. It sounds George thinks they trade lower, and it sounds like Gordon thinks they trade higher. So as a moderator, that's my vote on this one, but we will see the tail of the tape and what happens in the next several quarters. So
yeah. The last thing I'll leave our listeners with is I think just if you're going to watch a metric, watch what they do with new customers. And so I think that's going to be, if you see that inflect up, then I would definitely change my tune here. And that's what I'm going to watch as an investor. If you see that continue to suffer and the sales and marketing efficiency suffer, then I would stay away. So that's my 2 cents for what it's worth. But let's wrap it up, boys. As we always say, wolves make money, bears make money, pigs, they get slaughtered.
Say make money, money, make money, money, money. Make money, money, make money, money, money. Money makes the world go round. I'm the talk around town.